Hello, students. You are welcome to this third lesson. In first two lessons, first lesson we have seen introduction to partnership, and in second lesson we have seen the fixed capital account and profit and loss appropriation account and current account. In this session, we are going to see the fluctuating capital account for the partnership, right? In this, what they says is, we will see the question. ABC are partners sharing the profits and losses in the ratio, right, of in the ratio of 4 is to 3 is to 1, right? 4 is to 3 is to 1. Capital is 50,000, 30,000, 20,000. They brought the capital 50,000, 30,000, 20,000. Net profit was 240,000. Out of this, 15,000 shall be kept it for provision for contingencies. Provision for contingencies is for the unexpected expenses, emergency expenses. So for expecting natural disaster or anything, right? For that we are keeping a contingencies, right? Drawings are 17,000, 15,000, and 11,500. Partners are entitled to the interest on capital of 5% per annum. Prepare profit and loss appropriation account and partners capital account. That means it is the fluctuating capital account, right? So first, ABC are partners sharing the profits and loss in the ratio of 3 is to 1, right? Capital, so capital account by balance sheet or anything, 50,000, 50,000 and 30,000, 30,000 and 20,000. This is the capital they have brought in cash by cash, right? And profits and loss in the ratio capital net profit was 240,000. So by profits, right? PNL, profit and loss, right? 240,000 they have earned a profit during the year. Out of this, 15,000 shall be kept it for provision for contingencies. Here, provision for contingencies was how much they have made the provision? 15,000. 15,000 they have made the provision for contingencies 15,000. That is also okay, right? Then we normally for the company's account, provision for contingencies will go to the profit and loss account, whereas in the partners account it comes to the appropriation account, right? And 15,000 and provision for condition drawings are 17,000, 15,000 and 11,500. Drawings we will go to the capital account, right? Capital account drawings. How much the drawings, right? Drawings how much? A is 17,000, B is 15,000, C is 11,500. That is the drawings. Drawings. Hmm? Here we will see profit and loss appropriation account drawings, right? Drawings will not affect the appropriation account, right? It will affect the capital account and the what is that current account, right? Drawings. Partners are entitled to interest on capital of 5% per annum. 5% on 50,000 capital interest on capital, right? A, B, and C. And what is the capital? 50,000. 5% on 50,000, 2,500. 5% on 30,000, 1,500. 5% on 20,000, 1,000 rupees. Right? So you will get 5,000 is the interest on capital. Interest on capital. On capital. Right? 2,500 for A and for B 1,500, for the C 1,000. Right? This is the interest on capital. Drawings will affect the capital account only, not the profit and loss appropriation account. Can you understand? Okay, they draw the materials, right? It will affect the stocks or purchases and partners current account or capital account. Interest on drawings only will affect the profit and loss account appropriation account. Okay, so interest on capital we have seen. So this is prepare the profit and loss appropriation account and partners capital account, right? Okay, so we have done it, and now we are going to calculate the profit, right? To profit to partners capital account, right? Account interest profits transfer, right? A, B, and C. Understand? So right here we are balancing the account, right? The balance is the profit, right? Here it says 240,000 is the greatest amount, 240,000. Out of that, if that is the case, 000, okay, 220,000 is the profits. 220,000 is the profit. How they are going to distribute this profit is 4 is to 3 is to profit sharing ratio is 4 is to, they have given 4 is to 3 is to 1. 4 is to 3 is to 1. means you had to 220,000 divided by 8. Right? You'll see. 220,000 divided by 8, it is 1 is 27,500. That this one is 55,000. Right? No, into 3, no? 82,000, 82,500, 82,500 plus 27,500, 110,000, 110,000. If you add this, it will come to 220,000. Okay, that means 110,000 plus 82.5 thousand plus 27, 200. Okay, so here you will say profit by here you will say by P&L appropriation. P&L appropriation account, right? Profits, right? Here they say 110,000. This is 82,500, and this is 27,500. Okay, this will come to the profit and loss approach capital account. From profit and loss appropriation account, it will go to the profit partners capital account. In other words, if it is a non-fluctuating capital account, these all entries will go to the current account. Okay, so here you will balance, we have to balance it, right? Balance carried down. Okay, this is carried down, here brought forward. Okay, here you will say 50,000 plus 2,500 plus 110,000, right? 162, this is 162,500. Okay, 162,500. Out of that, we have to deduct the 17,000. Then 145,000 is the carried value. 45,500, right? 145,500. Okay, so that is our A. B is 30,000 plus 1,500 plus 82,500. It will come around 114,000. 114,000. Here you will say 114,000. Okay, out of that you have to deduct 15,000. Then 99,000. 99,000. You will say 99,000. In ours 20,000 plus 1,000 plus 27,500, then 48,500. 48,500. Right? After that, you have to deduct 11,500. Then here 37,000. Right? 48,500. Right? Here 37,000. then you can understand what is the meaning of fluctuating. Here you see brought forward balances by brought forward balances previous year 50,000, 30,000, 20,000 of capital account. Then the carried down value or brought forward value of the next year was 145,500 of A and 99,000 for B and C for 37,000. Have you seen? It is fluctuating. Earlier 50,000, it came to the 145,500. This is 30,000. From 30,000, it came to the 99,500. From 20,000, it came to the 37,000 rupees. Okay, so that is the difference. Here in fluctuating method, you won't get the current account, right? Current account, all the transaction which have been recorded in the current account will be recorded in the partner's capital account instead of recording in the current account. Okay, so this is the fluctuating method. Okay, this is the fluctuating method, right? So profit and loss appropriation is common for both system. Okay, understood? I hope you would have understood. So again, we'll recap this thing. ABC are partners sharing the profit and loss in the ratio 4:3:1, right? 4:3:1 profit sharing ratio, right, is given. Capital is 50,000. 50,000. Here we have brought 50,000. 30,000 and 20,000. Okay, net profit was 240,000. We have brought the 240,000 here. Out of this 15,000 had been, right, this is we have then done, this is we have taken, this is we have taken, this is we have taken, right. Now this is net profit, right, net profit 240,000 we have taken here, 240,000. Now they says 15,000 shall be kept it for the provision for contingencies. So we have made the appropriation for contingencies, 15,000. We have done it. Okay. So provision for contingencies is debited to profit and loss appropriation account. Okay. Contingencies and credited to the profit credited to the profit and loss contingency account, which will be shown under the reserves account, provision for contingencies under the current liabilities, right, in the balance sheet. Okay, okay, so that is done. And they have said 5% interest on the partner's capital account. Drawings for 17,000, 15,000. Here 17,000, 15,000, 11,500. The drawings. Partners are entitled. Drawings are deducted from either deducted from the purchases or purchases, and here it will debited to the partners capital account or current account, right. Drawings. And partners are entitled for the interest on capital of 5% in 5%. So interest on capital we have worked out 2,500, 1,500, 1,000 for partners appropriation account debit and credited to the capital account, right. Credit, we have done it, right. Now everything is okay, and remaining balance is the profits. This is profits. Now we are going to distribute this profit of 220,000 among the partners at the given ratio of 4:3:1. 4:3:1, that is 110,000, 82,500, 27,500 of out of 220 had been distributed among them, right. So profit and loss appropriation account debit and credited to the partners capital account 110,000, 82,500, 27,000. Right. Now you can see the difference between the brought forward at the beginning of the previous year, and this year brought forward what is the, it is fluctuating, balance is fluctuating from 550,000 it has gone up to 145,000, from 30,000 it has gone out up to 99,000, from 20,000 it has gone up to 37,000. That is a fluctuating, right? It's a fluctuating capital income. Now you would have understood this session, I hope. Right? Okay. And I will meet you in next session. You can practice more adjustments in this, right? These type of questions, if you adjustments, if you calculate these type of adjustments and see, then you will be familiar with this type of adjustment. These are the very simple adjustments, right? Okay, I hope to meet you in next session. Thank you.